What's up, everybody? It's Brandon LeCaren here, and today we are going to talk about how much should you be buying in real estate. That's right. So one of the questions I got asked this week, and I get asked all the time, is should I buy a $500,000 house all cash, or should I split it up into multiple investments? And the short answer of this video is you should split it up into multiple investments. And I want to go through the reasons why that's important, right? So, real estate is something that is exponential. What I say by that is, for instance, like if you were to go out and buy Tesla stock today, right? I don't know how much Tesla stock is today, but let's say it's $1,000 a stock, right? Well, in order to buy $10,000 worth of Tesla stock, you need $10,000, right? Well, let's say you want to purchase a $500,000 house. You could put down as little as 3%, right? So $15,000, right? And what that allows you to do, though, is it controls that $500,000 asset. So if you were to look at the growth of your Tesla stock, right, which is going to be, I don't know, like 6%, 7% year over year, it's only on that $10,000. Now, if you look at real estate, especially coming back where we were from in the pandemic, it was like 18%, right? But it's not 18% on the money that you invested. It's not 18% on that $15,000. That's right. It's 18% on the $500,000. So this is like essentially like your trading options here, right? So you control an asset. You control a $500,000 asset with only $15,000. But your gains is not based on that $15,000. The bank doesn't come back to you and say, well, you only invested $15,000 in this house. Like, you need to give us the gains on the rest of it. No, it is your gains. All of the money that you gain in the market value of that asset continuing to appreciate, that's all you. So $15,000 gets you to control a $500,000 asset if you put, 3% down. And you gain, like right now, roughly it's about 7-8% year over year is where we're seeing the average of home prices continuing to go up. So you get to see 8% every single year, and your equity continuing to go up. So was that $40,000 in year one that your asset continues to go up? Now this thing is exponential, right? Because then on year two, it's not 8% on like on $500,000, is 8% on the $540,000 asset. So as you can see how fast this $15,000 just continues to grow. And I mean, think about that, right? Like your cash on cash return is ridiculous. It's probably almost 300%, or your internal rate of return is like literally it's 3-4x, right? So in year one, which is amazing returns for those of you that don't know that. So that's why it's important to understand, like, hey, this is how real estate goes, right? So if you treat real estate like stocks, that's how much you'll get back, right? Like, you'll just get basic stock returns, right? So going back to our example of like, hey, should we buy a $500,000 house all cash, or should we buy multiple homes? So my take on that is, let's say you have $500,000 in cash and you just want to buy properties. I would buy 5 homes at $500,000 and put 20% down and get the sellers to pay all your closing costs. Now, the reason for that is because you now control, instead of controlling one $500,000 asset that continues to go up, 8% every single year. What you do then is you control about $2.5 million in real estate that goes up at 8% every single year, right? So that's the benefit of financing and using real estate, because like you want to control the larger asset for the least amount of money, and that's the best way to do it if you're going to put 20% down. The other benefit to doing so is you have tax benefits, because when you own investment properties and you have mortgages on them, those assets you're taking that off the bottom line, right? Like, so if your mortgage is, I don't know, $4,000 a month and your rent is $5,000 a month, you don't pay taxes on the $5,000. You pay taxes on what the remaining is, which is $1,000. So just think of it as like, you're also getting a write-off, and then you're showing like good business practices. The other thing too is You get interest write-offs, you get tax write-offs, and also you might still cash flow the exact same amount as if you were to invest into one property, but it's the growth. So like look at this. This is the long-term play, like, and like you have to understand that real estate is a long-term play. Understand that, because you have now $2.5 million in properties going up at 8% value every single year. So that is the key here, and this is why I would buy, 5 properties at $500,000 a piece, because I get to control $2.5 million in real estate compared to one asset at $500,000, right? And that one asset, even though it's going to continue, so it might give you some cash flow, it might give you a safe haven, but at the end of the day, you're losing out on a lot. Also, here's the other reason. Let's say that one person doesn't pay you rent in that month, right? So now you're out for the entire mortgage, right? Or you're out essentially, well, you're not financing it, but you're out for a certain period of time not collecting rent. Well, that vacancy, when compared to the financed properties of the $2.5 million, that's also like a tax write-off, right? So that's going against like your bottom line. You can write that off at the end of the day. Versus if you have it all cash, like you own it all cash, so there's no like massive write-offs, or you're not taking it off the top line, right? So that's one reason why I really love like being able to split up your eggs and put it in multiple baskets. I think it's probably the best way and the smartest way to buy real estate. A lot of people right now are buying a primary residence every 6, 7, 8 months, which is a great thing to do. And if you can, I recommend you do it. So hope you guys like this video. This is why I would buy, $2.5 million in assets versus one $500,000 property. Hit the subscribe button below, and I'll see you guys on my next video. Take care.